Hello, all. Thank you for joining us today. In this session, we will be talking about a defensive sector that has been witnessing a lot of changes lately. Quick commerce platforms contribute about 30 to 50% of overall e-commerce sales for FMCG companies. Big FMCG companies like Parle or ITC are racing to embrace the real-time data exchange to avoid stockouts. Then comes the rural market, which contributes to 35% of the total FMCG sales. Rural demand seems to be a worry for the big companies due to the presence of local firms and their play during lower levels of inflation. Seems like a lot is going on in the FMCG playing field. I'm sure this presentation will serve as a remedy to your questions. Without any further ado, let me call upon Mr. Senthil Manikandan, Senior Research Analyst, to take over.
Thanks, Tarun, and welcome everyone to this webinar on Saturday afternoon. This webinar broadly will start up with the current industry landscape in terms of for the last 5-10 years, what has been the key trends in terms of growth and margin wise. Then we look at a couple of initiatives from the FMCG industry players, how they are planning to take up the growth to the next level and things like that. And the last part, we'll cover the outlook and the valuations, and we'll end the sector webinar. So, yes. So going to the first part in terms of industry landscape. So FMCG being majorly a consumption side. So if you look at what is happening over the last year or 2 years, is that the overall GDP growth has been around 6.5-7%, and majorly if you see, this has been driven by the capital investment side. So from the government side, and also the growth in the gross fixed capital asset creation has been much more higher than the private consumption side. So there have been a lot of factors which have been contributing to this lower growth on the consumption side, majorly because on the rural side, we have seen that the inflation impact on the rural consumption has been much more higher than the urban side. And even till last quarter, the rural real wage growth continues to be lagging the inflation, especially on the food side. So that's one of the major reasons where we are seeing is that consumption growth has been lagging the overall GDP growth. But what's the outlook going forward is that I think inflation has been stable over the last couple of quarters, and we have seen in commodities like edible oil and its impact on consumption goods like detergents or soaps. I think edible oil has seen a drastic fall, and even one of the important segments like dairy has seen somewhat moderate inflation trend going forward. So with this, I think macro so far has been quite headwind for this sector, but it's turning out to be a positive one going forward. If you look at the industry size in terms of revenue, I think if you look at the core categories like home care, personal care, and then the packaged foods and then beverages, I think roughly the spend is close to around 5.5 lakh crores. And if you look at the margins wise, I think even though post-COVID we have seen a drastic increase in the commodity inflation, so the listed companies, especially the organized ones, have been very actively pushing for price hikes. So we have seen over the financial year 22-23, there have been sectors or categories within the FMCG which has seen double-digit price hikes. So via price hikes, I think the companies have been able to reduce the impact at the margin level. So if you look at the EBITDA margins, it used to be around 20% pre-COVID, and even now, I think with all this inflation and impact, I think the EBITDA margin continues to be around 20%. So broadly, this is the industry size and what's the current profitability that the major companies are operating. Let's get to the volume growth side, because volume growth is the key performance indicator with respect to FMCG, because that shows the where the consumption trend is moving. If you look at the last 15 years, right, I think if you look at the CAGR for the last 15 years, it has been like just 3%. So traditionally, the narrative of the FMCG industry is that, especially in India, is that with the developing country and we have a low penetration across major categories, and with our per capita consumption being local across categories, I think people have a narrative that FMCG growth at least should be in double digits, but it has not been the case over the last 15 years. There are a lot of macro issues, and within categories also, I think there have been some categories which have outperformed, some categories have been underperforming, and things like that. We look at one by one what are the reasons which has led to this subpar industry growth. Because if you take a real GDP growth of around 6-7%, I think the FMCG volume growth has been like 0.7, 0.8% of the real GDP growth. So that's where the industry volume growth has been so far. And especially in the last, if you take post 2015, you see, I think further, I think there has been a steep subpar performance in terms of volume growth. So, what are the major reasons for this underperformance versus the expectation? Was that we know that there have been a lot of macro headwinds in terms of post 2015. We saw like demonetization, GST implementation, then we had COVID. So all those things has impacted the consumption, especially on the middle class households. So if you split the FMCG consumption across households in terms of income bracket, so the data shows that around 60 to 65% of the FMCG consumption is by the middle class income households. So especially this segment of households has seen a major impact on their income revenue streams over the last 3-4 years, with respect to right from like, not only 3-4 years, even before that, before COVID also. So that has been one of the major reasons why the both volume and revenue growth has been in low single digits in the recent past. And this is from the macro side. And if you look at the industry side also, so the FMCG industry is seeing a technological shift towards e-commerce, and then now last 2 years there has been a quick shift towards quick commerce, especially on the metros and tier 1 cities. So on the distribution side, the established companies which used to have a strong foothold with their millions of outlets of distribution, they are facing a new competition in terms of D2C brands. And so these are also one of the this is the recent not 2 years, but overall, I think macro coupled with income impact on the middle class income, these are some of the key reasons why the volume growth has been lagging the expectations. So this is the company wise, we have seen that if you look at FY 2010 to 15, I think the volume growth and the revenue growth has been in the double digit range in terms of 12 to 20%. And then if you look at from the year of FY 15, I think the revenue growth has been in low to high single digits only. If you look across companies, these across personal care, packaged goods, beverages. So across categories, this has been the overall picture in terms of volume growth. So, so with this industry landscape, I think there is a clear need for the sector to up its or reignite its growth assumptions in terms of bringing back the volume growth is the key need for the sector, and increasing the categories growth. Otherwise, I think because so far the companies have been much more fighting the inflation and then focusing on the margins. So with moderating inflation, I think most of the management's focus is now on bringing back the volume growth. So we look at some three key initiatives which are taken up by the companies in terms of bringing back the volume growth. The first one is that, so this we have discussed. So the first one is that increasing the addressable market in terms of adding new categories, replacing its existing brands. So that is adding new categories on the adjacent sites. So this is one key initiatives which we are seeing taken up by companies in this sector. And the second one is that focusing on innovations. So instead of just gaining market share from the existing players or unorganized players, creating new segments is going to be the clear growth driver going forward. And with the changing landscape in terms of consumption basket. So the next 5-7 years, broad expectation is that as we move from like a $2,800 to $3,000 per capita income, as we double this per capita income over the next 5-7 years, the consumption basket of the middle income household is going to see a drastic change. So as investors, I think focusing on this wallet share and where this wallet share is going is going to be the clear indicator for the categories growth. So companies has to create new categories, has to enter new categories via innovation to drive the entire volume and revenue growth. And the third is that premiumization. So within the categories also, we have seen that over the last decade, there has been some categories which has seen a higher growth than the sector because the companies has undertaken this premium category in goods. And this has been adopted well by the, let's say, the top 1% to 5% of the population. And this is going to go deep into the middle class as they come to the upper income or upper middle class segment. So these are the three initiatives which we are focusing, which will enable the companies to push growth and grow at a double-digit revenue growth over the next 5-7 years versus the earlier low single-digit growth. Let's start by the first one in terms of building the adjacencies. So here, I think there have been two strategies that are being followed by the companies. First is that organic way of adding adjacencies. So here the companies use their existing brand. For example, here Dabur, we all know that Dabur has a real brand for their juice segment. So initially it was for just juices. So what the company has been doing now is that with they're just replacing the real brand and making it a mother brand, and then they're entering into all the new categories which are adjacent to the juices. For example, if you look from just juice, they have just entered into the plant-based drinks, and then they also entered the dairy-based milkshakes, and then now with beverages, they're extending the brand to the superfoods in terms of offering chia seeds and everything, and also they're entering the foods in terms of peanut butter, etc. So this is one type of strategy. This followed across brands. For example, you can take Marico. Marico, they have Sapola. So initially the Sapola brand, we all know it stands for the healthy edible oil segment. Over the last, if you see 5-7 years, they entered oat segment with Sapola. And they have seen a good success in terms of garnering a #1 position in terms of masala oats. Using the Sapola brand. So they have created Sapola brand as a mother brand now. So apart from oats, now they have recently entered into Sapola honey, etc. And they're also entering the healthy snacking category also with Sapola. So this is one strategy which is followed across companies from Dabur and Marico in terms of utilizing the current brand to a mother brand status and then entering into newer categories. So this obviously helps them in terms of taking the mind share of the consumers at a lower time period instead of putting up a new brand. So the second strategy for adding adjacencies is going inorganic. So here companies opt to acquire companies which are in the same segment where they are operating. For example, here we can see the Tata Consumer. So Tata Consumer is one of the top two players in the tea segment. Here recently in the last quarter, they went and acquired a company, Organic India. So Organic India is majorly into herbal tree and herbal infusions, which is mostly adjacent to its tea category. And they also get another company, Capital Foods, which is into Desi Chinese FMCG category. So this is aligning with their Tata Sampann Foods segment. So here Tata Consumer is in the via inorganic route. I think so they are expanding their adjacencies and entering into new categories or extending their categories, thereby pushing for more growth. So this is the first part in terms of how companies are looking to increase their revenue growth. So like I mentioned, if you see that this has been across companies. So we have seen about Marico and Dabur and Tata Consumer, and even Britannia. It's one interesting space where Britannia, from being a core biscuits manufacturer, they have entered into earlier. They entered the bakery segment with the rusk and cake. Now their focus is on becoming a total foods company. So recently, last quarter, they have entered into the healthy salted snacking category also. And dairy category, they also formed a JV with Bell Foods to enter aggressively into the dairy category. So this is where across companies we are seeing that either via organic method or inorganic way, companies are looking to expand into their core categories or expanding away from their core categories. Second trend in terms of pushing for growth is premiumization. Here, if you look at the last quarter, this is a slide from Unilever on their Q3 presentation. So here clearly it shows that the mass segments has been underperforming, and so if you have read across newspapers, I think there have been a lot of articles over the last 1.5 years in terms of how the economy has moved to a K-shaped recovery. So these are also one of the key points that shows that K-shaped recovery has been predominantly reflecting in the consumption side. Not only with respect to FMCG, we are seeing it across automobiles also. Like in terms of entry-level cars, growth has been subpar in terms of volume growth, while the SUV growth has been in double digits. So here, even in FMCG basket, products which are in the mass category has been seeing lower growth, while the premium category products has been in terms of close to double digits growth. So this is where this premiumization trend is led by the macro side, because on the higher income households and who have been not impacted by the macro issues, I think their consumption has been overall stable. And the second impact is that even the companies are much more focusing now on these categories. As you can see here, that even in a category like salt, which has been traditionally been not been actively looked at as a growth category. So here, even companies are trying to put out new brands or existing brands, and then put out new products in terms of how the category can be premiumized. So like you can see that the mass segment, if you see the Tata Salt, it is trading at like 15 rupees or 20 rupees. But if you see the premium, not super premium, even the premium version, I think the ASP is close to more than 4 to 5x of that of the mass segment. So this is where the companies are planning or focusing on increasing the distribution of the premium products. And then with over the next 5 to 10 years, I think as the middle income households who contribute to 65% of the FMCG spends, as they graduate to upper income, I think gradually people will shift from mass to popular and premium. And this will be like one of the biggest growth drivers for the FMCG companies. And so one category which has already established its present in the premium category is that detergents. So HUL has done in terms of good strategy over the last 10 years in terms of how company can premiumize a category. So if you look at 2010, the premium laundry's contribution to the HUL portfolio is like 1/3, like 30%. But now it's like around half of its detergent portfolio is coming from the premium laundry segment. So this is a big eye opener for the entire sector because for the next some years we can expect many categories to have like half of its volume coming from this premium category. And the third driver is the innovation in terms of bringing new products or creating new categories itself or creating new markets. So last quarter, I just handpicked a couple of innovations from the last quarter from the FMCG side. So one key innovation is from Godrej. Here we can see that Godrej, they have been traditionally being a market leaders in the household insecticide segment. They have a good name brand. So last quarter they entered a new segment or a new product here. So far this segment has been completely unorganized or majorly it's been supplied by the illegal influx of industries. So the so this is where the company brought in a new product in terms of mosquito agarbattis. So here they have also got a new molecule for this. So this is exclusive molecule for the company. So they have monopoly over this in terms of product and R&D. So the market size is quite big. It's like 1,200 crores of market, which has not been penetrated by any of the organized players and completely now it's unorganized. A new player entering with a much more advanced product and then with their branding power, I think they can garner the Indian market or at least they can garner much higher share of the market over the next 2 3 years. So this 1,200 crores of TAM is completely new for Goodnight because Goodnight currently operates in a completely different category in terms of addressing the mosquito anti-mosquito repellents and things like that. So so innovations help companies to enter into a new category and if the category is of a substantial scale, like substantial size in terms of like more than 1,000 crores to 5,000 crores, I think that's where the push for revenue growth comes in. And one more innovation from the Godrej side is that on the fabric care side. So we have seen how HUL has done a good work in terms of expanding the laundry segment from the mass to the premium side. And now, for the last 3 4 years, I think mostly on the metros and Tyrons, we have seen that with the higher penetration of washing machines, especially the front load washing machines, more and more people are getting adopted to the liquid detergents. And if you look at currently the products available in the market in terms of selling prices of liquid detergents per liter, a liquid detergent will cost upwards of minimum 160 170 rupees if it takes a Excel or Ariel. And Godrej has just last quarter they launched a liquid detergent at a price of less than 100 rupees per liter. This is one of the major innovation because they are addressing a segment which is a segment of people who are completely different from those who use Ariel or Surf liquid because this product comes at a 50% discount to the existing players. And I think this will help people graduate from the powders to the liquid detergents. And we have seen that the stickiness, once people have moved from powders to liquids, I think they don't reverse back to powders. So the premiumization trend will continue along with innovation. So this is where the Lollapalooza, the impact comes in, where various initiatives taken by the companies bring back innovation and pushing the growth. Yeah. So far we looked at the industry landscape and what the companies have been taking long-term initiatives in terms of enhancing the industry growth. Now we'll dive into the FY24 numbers and see where does the company stand. And so far, so the volume growth has been slower than expected, and even the second half of FY24, we don't expect a major volume growth because initially when FY24 was started, I think there was expectation that rural will start recovery, but there has been some slowdown in terms of rural growth, which is continuing it now. This is because of the erratic winter we saw last monsoon, especially. So the monsoon was like normal, but in terms of distribution, it was like subpar. So that has resulted in the rural consumption side. And as inflation moderated, so one key issue that has come up in the 24 is that the competition has intensified from the regional players. So as inflation came down, I think the regional players are once again back into the market, and they are completely disrupting the market with respect to the pricing. So even the organized players have started to take price cuts to keep up the market share. That's one key development that has happened in the 9-month FY24 numbers. And this has been put out by the market leader HUL in its latest presentation itself. So we have seen with monsoon, uneven monsoon, and then weak macros pushing up the consumer sentiment to be continued to be weak. And urban continues to outperform the rural so far. So if we dissect the Q3 revenue growth into value and volume mix, except for one company, Jyoti Labs, which has shown a double-digit value and volume growth, I think most of the companies has been in flat or low single-digit volume growth. So this shows that the consumer sentiment continues to be weak, and especially on the rural side. And one more major driver is on the distribution side. If you see that across channels, general trade, which is the local or kirana shops. So the growth at the kirana shops is lagging the modern trade. So this is a quarterly volume growth trend across major FMCG companies. As discussed in the last slide, the trends continues to be low. So the rural recovery is, I think we are close to recovery, but we are yet to see, because we are seeing a recovery in the rural segment via the two-wheeler sales. So the two-wheeler sales in the last quarters has been picking up. So that's one indicator of where the rural sentiment is there. So going forward, I think with normal monsoon expected over the coming monsoon, I think we should see revenue growth and volume growth picking up going forward. And with respect to the channel base, the general trade, which is like 80% of the industry, continues to be very poor in terms of volume growth. This shows that the low income, middle income people segment continues to be weak. And broadly, the comments from the managements of the FMCG players is that, like we discussed here, the competitive intensity from the local players continues to be high. I think this may go out in the next 1 or 2 quarters, because the traditional established players have also started to take price cuts. So this will be a short-term impact. And so overall, so the urban growth and rural growth has been the gap between the urban and rural growth has been reducing. And with normal monsoon expected, I think this should narrow, and then we should see the rural recovery going forward. So this from the comments from the Unilever the Q3 slides. Here we see that the rural market growth is like till in on a 2-year CAGR basis also it's like just 1%. So versus the urban market of 3%. Yes. And broadly, as we discussed, premium continues to outperform the mass, and the expectation for recovery is will be gradual going forward, and it won't be a very aggressive recovery going forward. Gradually, over the next 2 quarters, we can expect improvement in volumes driven by rural segment. And we've seen the revenue side coming to the margin trends for the 9-month period. So with falling raw material prices, I think the companies have enhanced their gross margin, and they also started increasing their ad spends. So they started spending more on ad spend in terms of pushing for growth. So even though the increase in gross margin has translated in the same way to the EBITDA, but we've seen a good EBITDA margin expansion with the higher ad spends. And even going forward, our expectation is that we expect margins to stabilize around these levels as companies will push for growth. So we have seen it in the biscuits category in the last quarter also. Companies have started to push for more grammage per packet. So during the inflation period of FY22 and 23, what companies did is that they not only raise prices, but there are in certain SKUs where the company can't raise prices. For example, 5 rupees biscuit packet. It's a price point they can operate. They can't tweak it to 6 rupees or 7 rupees. So they just reduce the grammage for this price point. But now what's happening is that with falling inflation, they have just restarted to increase the grammage. Also, they have started giving promotions and discounts, etc. So this is a major reason that bringing in that the margins will stabilize going forward. The much of the inflationary benefits will be passed on to the consumers. So like discussed, I think the more grammage is being offered to the consumers. So this will reflect in the upcoming quarters results, where we can see that there will be a volume growth which will be much higher than the overall sales growth. So you can see at least for next quarter or two in terms of volume growth being much higher than the sales growth. So outlook for the industry in terms of growth and margins and profitability. So if you look at the last decade, you have seen that organic growth has been like high single digits, and the companies have aggressively focused on the margins. So thereby the EBITDA margin expansion was close to around 5%. So thereby profitability was much higher than the revenue growth. But going forward, we expect revenue growth would be around 10 to 12% in terms of the band. And margins probably will be stable. So thereby the profitability will be in line with the revenue growth. So this is where the broad expectation going forward, and we will look at the valuations at the last. And what are the key drivers for this outlook for growth is that one is that government spending on the rural side. So once the elections get over and the final budget, the full budget gets published, I think we will come to see what's been the allocation towards the rural side. So far in the last interim budget that the government has posted, I think there has not been a substantial increase towards the rural segment. As you can here see that from around 8.2 lakh crore. It has been around 8.3 lakh crore for FY25. So that just a 1% increase in terms of uh, spending towards rural side. So we have to watch for this number in the upcoming full budget. So that will give us a clear point in terms of rural recovery. And one more key point which we have to see is that how is the middle income households income growing? So as you can see here that if you take the across consumption categories, the middle income's share of spends in the FMCG is the highest, and along with two-wheelers, so it's close to around 60% in terms of share. So the middle class income households has to increase and has to see some stability, and their view on the economy has to improve. So the consumer sentiment has to improve. So that's where the focus should be going forward in terms of getting our assumptions right on the industry side. And we have seen in the last 2 3 years in terms of the growth in categories like SUVs have been doing good and leisure travel. So travel post COVID is being like growing at double-digit rates. So that's because if you see that the top 16% of the households has like 90% of the share in buying a passenger vehicle. So these kind of categories hasn't gone through the impact in terms of slowdown. While FMCG has seen a higher slowdown impact because of its higher share of spends coming from the middle income people. And so we have to watch out for the growth across categories because even if you see that last 15 years, there has been some categories which are growing at a higher rate than the overall industry growth. So as people graduate into from a middle income to upper middle income, the volume growth in particular categories like healthy snacking or beverages, foods is expected to be much higher than the traditional personal care or which includes or a home care like fabric care or detergents will be much subpar in terms of growth versus emerging categories like ready to cook, beverages, foods, etc. So when analyzing companies, I think one has to be cognizant of that does the company operate in terms of categories and does they have the enough levers to take that core category to offer to the emerging categories. And so broadly, the headwind side or the risks to the growth assumption is that so on the structurally we see that distribution has been the core strength for the established FMCG players in terms of competing with new competitors. So if you look at 5 7 years back, if a company has to put out a new FMCG product, I think the company has to have a higher marketing and spends, and then they should have a distribution setup. So this will at least be like 25 30 crores, at least for a product to get it into the market. But with the emergence of e-commerce, we have seen that the D2C model has worked out very well, and then the new competition now there is a lower entry barrier in terms of new product introductions. Uh, so this is where we are seeing that the entry barriers has been going down for this sector. So we have to see how the established players upping their own digital landscape and then upping their own digital infrastructure to compete with these new competitors. And one more factor risk is that private labels. So across retailers, so the retailers been increasing focus towards private labels because it offers them a much higher margins. But we have to see how the consumers adapt to this private label. But this has been a phenomenon for the last more than 15 years. But its adoption has been a bit slow. But we have to see how this private labels impact the overall growth. Yeah, these are the couple of major headwinds. Then moving to the valuations. So we have seen there's been a substantial re-rating of the companies over the last decade, and this is because as the companies are improving their margins and profitability metrics, traditionally they operated a low capex business model. So this has pushed up the ROEs and things like that. So if you do your DCF valuations, etc., I think with a double-digit terminal growth rate, these valuations might be reasonable. And we have seen a time correction happening in the space for the last 1.5 years, with the segment underperforming the overall market. So it's a pretty interesting space to watch for now. And as we see growth recovery coming back along with stable margins and profitability, I think the overall segment is poised to do well for the next 3 years at least. So this we have come to the last part of the presentation in terms of funds performance. So True Blue is a large cap fund, and these are two active large cap fund. And so just a bit about our investment philosophy. So we always focus on the long term. Long term, I mean, like at least a 3 year time period in terms of investment decisions. And it's been a contrary thinking, because that's where the scope for creating alpha is there. And then it continues to be bottom up approach in terms of analyzing companies. Even within FMCG, I think we have played out in companies where there was a substantial scope for improvement in their core categories. And so that kind of investment decision is coming from analyzing the categories particularly. So, and then focus on the risk management. So True Blue as a fund, so it sits perfectly in terms of both India growth story and the global champions, because here the focus on companies which not only taking part in India growth story, but they are also addressing the global markets. So that's where the fund plays. And then so it's a 100% large cap portfolio. It's actively managed, and like I mentioned, it's a low churn portfolio and long term decision making philosophy. And we don't have any fixed fees, so it's completely a performance oriented fees structure. And currently, portfolio, if you look at, we have like around 23 stocks. And in terms of active fund management, here you can see that top 10 stocks of the fund versus the index. So here you can see that so the index, you see L&T is like fifth, we have HDFC Life, we have Bajaj Auto. So these where the active fund management comes in, and see the top 5 stocks weightage is around 40%. But if you look at the next 6 to 10 stocks, we have like a 25% share, while the Nifty has only 70%. So these where the active fund management comes into the picture. And the focus is on the risk management side. If you look at the last 2 drawdowns in the market, if you take the past, like in June 2022, across funds, True Blue has outperformed in terms of drawdown. Like we have seen large cap funds, mutual funds declining close to around 20%, but True Blue drawdown was just 12%. In the subsequent drawdown in the March 2023, we have seen that the funds drawdown has been much one of the lowest in the category. So this shows that where we focus more on the risk side. And broadly, our endeavor is that to outperform the benchmark with around 200 to 300 basis points of outperformance on a 3-year rolling basis. So these where the long-term investment thinking also comes into the picture. Broadly, the product suitability is for across the investors. So this is a fund structure and in terms of holdings. And if you look at the beta of the fund is just 0.7. So this shows the risk metrics. And investment team, I think you all know, it's managed by Shyam Shekhar, who's the fund manager, and we have GR Balaji, who is a co-fund manager of the fund. These are broadly our investment team, and this has been our performance over the last 1 year, 2 years. So we broadly look at a 2 year or a 3 year rolling period only. So a 2 year rolling period, we continue to be outperforming. So that's where our focus time period is that. And these are key terms in terms of performance. So yeah, that's it on the today's webinar. We have covered the FMC side and broadly our fund offering on the large cap side. So if you have any questions, we can take it up. We can just post it. Yes, Rakesh, you can just unmute and yes.
Hi, Senthil. Thank you very much for the opportunity. And first of all, thank you for the detailed and a very precise presentation. I have a one question. I have two questions. First question, if you showed the way like in the last 7 to 8 years, the volume growth of the FMCG companies has remained below 10%. What gives you that confidence that in the coming year it will be 11-12%? Because there will be some years when the inflation will be lower than in that particular year the volume growth would have been higher. But if I look at all the years, the volume growth is lower. But now you say things will be very good from this year. What gives you confidence, or what are the factors that you have looked and think the growth will be there? Thank
Yes.
you.
Yeah, thanks, sir. And, so expectation is that it will be a gradual recovery going forward. Uh, so one major reason for the outlook to be much better versus the last 2 3 years is that one major that is the rural recovery. So rural. If you look at the rural's real wage growth versus the rural inflation, so it continues to be on the negative side. So this shows that the consumer sentiment continues to remain weak over there. And rural is like a 40 to 45% of the overall industry in terms of spends. If you look at broadly, and maybe in some categories, they may be higher or lower. So particularly, rural will be one factor to watch out for going forward. And second one will be the improving consumer sentiment in the low and middle income households. As you know that post-COVID, we have seen the impact of the pandemic on the lower income and the middle income households has been much higher than the upper middle class income households in terms of income stability or the income volatility. So we have seen that the last 1 year at least that portion has been stabilized. So it has just stabilized in terms of income volatility. So now going forward, I think we can expect income growth in these low and middle income households. So with the rural recovery and then the improving income growth on this low and middle income households will be the two key factors which will enable the better growth prospects for the industry going forward. And along with that, with inflation has impacted the volume growth. But with moderating inflation, volume growth should be the major driver for the revenue going forward. So the pricing will be much more moderate. So if you look at the revenue growth, if you split it with value and volume mix, the going forward, the sales growth will be driven by the volume growth, which we expect to be at least high single digits, and plus a moderate price hikes in terms of 2-3%. So that should push the sales growth to be in terms of around 10% in double digits range. So this broadly, there may be some companies or categories which may be in growing lower, but as a sector, this is broadly our expectation.
Thank you, Senthil, for the answer. One last question from my side. When we look at the share of other, like the modern retail as well as e-com players going in the total sales of the FMCG companies, where do you see the margins in the future? Because what we have read, what we have seen, when the share of the like modern trade or the e-commerce has increased in the years, what has led to improve the margins getting shrink. Like if we have seen globally Walmart, we have seen globally Tesco, where they procure higher or the more quantity from these players and they reduce the margin. What's your view on that? Thank you.
Yes, I think it's a very interesting question in terms of how the channel mix will be going forward and its impact on the margins. Because uh, so currently, if you look at the channel mix, 80% of the revenue or the sales is coming from the traditional general trade, which is the our local kirana shops. And another 10 to 15% is from the modern trade. And then the e-commerce is currently around 5 to 6% across companies. This is the current split up in terms of channel mix. And so within the channel also, we have seen emergence of B2B distribution players. So these guys, if you see, traditionally the distribution setup is like from a wholesaler, then a dealer, then a retailer. Now we have got a new kind of people who are B2B wholesalers, and then they have tried to create a new kind of distribution map. So that, but that hasn't fructified so far because the stronghold of the existing distributors and their hold on the general trade continues to be there. So at least for the next, the short term, like 3 to 5 years, we don't expect a major change in terms of mix. We expect kirana stores and general trade will continue to form at least 80% of the entire sales. And your question on the e-commerce and quick commerce impact on the margins. So if you look at the how the FMCG companies is playing this quick commerce or the e-commerce thing is that they have a different kind of SKUs, particularly for this kind of channels. So what we traditionally see on the local kirana shops in terms of SKUs, we won't be seeing the same kind of SKUs on the e-com or the quick commerce. So with the companies play around the SKUs, they play around product categories. You might see a higher share of premium goods on this quick commerce or e-commerce. So with this kind of product mix and categories, I think there is a scope for either maintaining a stable kind of margin or there is scope for higher margins from these new or emerging channels. And modern trade has been there for last close to 2 decades, and there has been no big impact in terms of margins for the FMCG companies. Yeah, hope that answers your question. Just some questions on the chat box from Damodaran was asked on there is no FMCG. True Blue, we have a fair share of FMCG stocks in the fund. So it's so what we have showcased in the presentation is the top 10 holdings. So yeah, so we hold FMCG stocks in the True Blue fund. And another question is on the from Patabi. What is the outlook for HUL and Nestle? How long can outlook? So I just don't want to take up the stock specific questions, but so like I mentioned, overall category as an industry, I think they have went through a lot of volatility in terms of raw material inflation and headwinds in terms of consumption weakness in various categories. So now most of these headwinds have slowed down. So and management because management focus was predominantly on how they can manage the profitability margins and things like that. Now they can focus more on the growth. So that's where the assumption is that you can get a higher growth going forward across this category. And Srinivasan Ramakrishnan, yes, I think this presentation will be put up on our YouTube channel. Yeah. can watch the presentation. Yeah, if anyone has any questions, you can just put it in the chat box, or you can just raise your hands. I can just unmute you. So if there are any no more questions, I think we can close the presentation. And thanks everyone for joining us today. And yeah, thank you. And thanks, Tarun. Can close the webinar.
Thank you, sir. Thank you all for joining us today.
Thanks. Bye.